Hi and welcome to Business Economics Revision session number 4. In this particular session, I'm finishing up on the question paper that we started dealing with when we did our session 3 of revisions. This is June 2019, 1.3 Business Economics for Zika exams. So let's go to that particular question paper and pick it up from where we had left it. So that's Business Economics for Zika 1.3 June 2019 exams. Had done section A, question 2 and question 3, so we'll pick it up from question 4. Question 4. Okay, so there we are for question 4. All right, so question 4. From the data below, calculate the gross value added at the basic price, formerly called the GDP, at factor cost using the expenditure approach. Now, there are 3 different methods you can use for calculating GDP. The number 1 method is the expenditure method, where you add up or aggregate total expenditures in the economy. The other method number 2, is the income method. This one, you gross up all the incomes coming from the supply of factors of production. These are the incomes are called factor resources or factor incomes. Then the other method is the value added method or the output method, where you calculate the value of what has been produced in the economy. So those are the 3 methods. Now, in this particular question, they want us to use the expenditure method, so aggregating expenditures in the economy. So the expenditure method, GDP is equals to consumption expenditure plus government expenditure plus investment expenditure, then plus net exports. Net exports is the export value minus the import value. It's a very simple method. So let me show you how we can do this. Let's go to our answer page. Okay, so there we can insert a simple table. First of all, the method is highlighted as follows. This is GDP equals to consumption expenditure plus government expenditure plus investment expenditure plus net exports. That is exports minus imports. M stands for imports. All right, so that's the formula. So we are going to apply this formula on the data that is given in the table. We'll refer to the table anytime soon. So this is the formula that we are going to apply, but we'll apply this formula in a vertical column, where we get consumption expenditure, government expenditure, investment, and net exports. So let's insert a table that we are going to work with. Okay, so that will be enough. We just need 2 columns. 2 columns will be okay. All right, so that's okay. Quite so let's start picking the items from the question. Let's get back to the question. So we need consumption expenditure, and we are given consumption expenditure is there. That's the 115,000. We need government expenditure. We've been given government expenditure there. That's the 8,500. If you can check it there. Then we need investment expenditure. Investment expenditure is coming in form of value of increase in stocks, something like that, value of increase in stocks. And then you also have the capital formation. So investment expenditures, we have those two there. We're going to pick those two figures. Then exports, we have it there, 75, and imports, of course, we have it there, 68,000. So we have most of the things. Now, when we do these expenses or costs, we are going to calculate the GDP at factor costs. Then we at the GDP at market price. The GDP at market price. When we adjust for taxes and subsidy, then we are converting that value to a GDP at factor cost. Right? GDP at factor cost. So let's start. So we have consumption expenditure. Okay, so consumption. The value for consumption expenditure was 115,000. Next, we have government expenditure. So government expenditure, the value was 85,000. The next one, we have investment expenditure. We have two of those values, the gross capital. So the gross capital is 50,000. It was 50,000. Then we have increase in stocks. Increase in stock. So that value there, increase in stock, was 8,800. 8,800. So when we add those two figures, we have total expenditure, but we need to add imports and exports, so we can do it directly there. So add export value. The export value was 75,000, and then less the import. That's the net export. So less the import value. The import value was 68,000. So we are subtracting this one. 68,000. So what we get there is the GDP at market price. The GDP at market price. So GDP at market price. So the total value there should be 265,800. 265,800. Then when we adjust for taxes and subsidy, we have the GDP at factor cost. So less tax. So tax is 35,000. And then add subsidy. And the subsidy value is 25,000. So what we get there is the GDP at factor cost. And that GDP should be 255,800. All right, so that's the GDP at factor cost using the expenditure method. As the expenditure method: consumption expenditure, government expenditure, investment expenditure, and net exports. All right, so let's move on and look at the next question. Okay, so using the data in A above, explain 3 approaches Zambia can use to measure national income. I've already talked about the 3 approaches you can use to measure national income. So let's just highlight that one again. So the methods that you can use include: number 1, you can use the expenditure method.